Hello and welcome to another video by HKCM Global. My name is Joe and as just promised, we're gonna dive straight into a couple of charts that I brought for you to give more orientation on where we're currently at in the financial markets, especially the American markets, the S&P 500 index that currently really is struggling to stay afloat and not slip into a full-blown recession. Because what I brought here for you is the so-called Sahm rule recession indicator, a historic indicator developed by a member of the Fed all the way back in the 1950s. Well, first of all, what exactly does this indicator do? The indicator tracks the development of the unemployment rate within the United States and compares current numbers and tracks the speed of change in those numbers. So basically, whenever the unemployment rate in the United States rises especially quickly, the indicator spikes, indicating a recession. And what you can see here, for example, first in the 1950s, 60s, 70s, but every single recession, it spiked and it indicated it perfectly with a little bit of a lag. Sure, it's a lagging indicator, but it indicated every single recession. And this time we are here again. Of course, this huge spike, that was the COVID lockdown madness, but we have not been this high in the Sahm rule recession indicator up until, well, basically ever since 2010. So what we see here, the spike here on the indicator really is of quite high significance. But as just mentioned, it is a lagging indicator, not a forecasting one. So if we get super lucky, there is a chance that we already are out of the woods. We have already seen the lows and the worst is over. And if that was to be the case, it would be a little similar to this period over here where we quickly just spiked into the recession indicating territory and then turned all the way back down. So we could see a move like this here again. But that of course remains to be seen. What I also brought for you, a different chart that might be indicating the very same thing. I got here for you the S&P 500 index, but not in nominal dollar value, but divided by the total M2 money supply. So this chart here tells us over a period of time how much money of all available money out there in the system has been held by stock investors inside the S&P 500 index. So in the S&P 500 evaluations. And again, also here we see historical similarities in the chart. So if we go, for example, all the way back to the late 1990s, not a time where I was in the financial markets yet, but back in the 1990s, we also saw a strong rally similar to the one that we have seen ever since July of 2023. And we have then likewise seen a sharp correction all the way down to this low. And we now also have seen this again, sharp correction all the way down to this very low in the chart. And then from this point onward, we had a massive rally to follow through. So that's close to, well, it is 50% in the high. So if history here in this case is any indication, we could likewise already have the lows in and see a new bull move to continue from here onward. And just a quick reminder for you, if you are interested in such indications and if you're interested in market analyses, push notifications, market entries, we currently have a discount of 20% off on all our analyses. Link down there in the description below. That will take you straight to our website where you can check out all the packages that we have available. We have 200 markets that we analyze on a daily basis. We give you entries, target zones, push notifications, trading areas, you name it. And we send out daily updates on whatever package you subscribe to. So huge value for you, currently 20% off. Don't miss to check it out. But back to the charts. What I also brought for you here is the maximum wicks chart of the S&P 500 index. And what we do see here is on top we have the S&P 500 and on the bottom we have the VIX, the Volatility Index. So that means whenever the market price action is moving wildly up and down, we get a spike here in the VIX. And historically, what a huge spike in the VIX always meant is that we were very close to or we were directly at a market low and that a pivot point was already occurring or a pivot point was very close. So for example, going all the way back to 2015 here, we had a spike in the wicks and we had a low in the market only 1 month later. This here is monthly candles, so the low in the market was only a month later. How many percentage points was it? It was about 5% lower. So if you had already called the low over here, not a huge miss. So then next big spike of the VIX that we had here. Again, big spike in February of 2016, perfectly caught the low. Another big spike here of the VIX in February of 2018, not directly the low, but the low occurred 2 months later at, again, roughly 5% down. So, and you could probably see for yourself that in the other instances, also here, almost perfect call of the low. Here, perfect call of the low. Only indication that I don't like so much, where I think it missed, was in August of 2024. It also called a low. Well, it technically was a low. It was not really a real low because we didn't really see a sell-off, but there was quite a bit of volatility and we still followed through with bullish movement. So it was a low, if you want to call it like that. And now again, in this very month, we also have a huge spike of the VIX, indicating possibly that we also already have seen the lows. Which brings me to our scenario here for the S&P 500 index, because it also aligns with our wave count. Of course, in our Elliott wave count, we do not consider things like the volatility index. We do not look at this day-to-day price action, but we have long-term counts that we establish in the markets. And so for the most imminent picture that we have here for the S&P 500 index, we conclude that we have seen a wave 3 tops. So a wave 3 is always the third wave out of a 5-part wave structure. And ever since the wave 3 top, we have seen a corrective pattern in an A, B, C correction, leading all the way over to an overreaching W wave. That means that currently we expect a relief rally in an X wave and then to follow a final corrective Y wave, leading all the way down here to the bottom of this overreaching wave 4, following this same wave count here of the wave 3. And then after we have reached this wave 4 low here in the pretty much exactly same price regions that we already have seen here for the wave W low, only after then would we conclude the wave 4, so this whole corrective phase to be over, and we would conclude a new wave 5 to unfold, taking us to newer highs already. So that's for our primary scenario. We also have a secondary scenario, always on our charts here, marked with the dotted lines or dotted arrows in this case, currently estimated at a probability of 33%. And in this alternative scenario, we would already have seen the alternative wave 4 low in already. And we would now directly see new highs in this wave 5 to occur. But that's only the alternative scenario. With our main scenario, we still expect a new low, and only after this low, we expect then the wave 5 to unfold. But what about the bigger picture then? On the bigger picture, we have here the very same story. I just walked you through that scenario of the wave W, X, Y correction, leading us into the wave 4 bottom. But in this overreaching time frame here, we also, for the overreaching alternative scenario, we conclude that we could maybe already have seen an alternative wave 3 top in back in February of this year, 2025. In our alternative scenario, we conclude that the wave 3 high could already be in over here, and we would already, without new highs in the meantime, see this huge corrective wave 4 move to unfold, taking us from current levels all the way down to at least another 25% down, potentially all the way even to, roughly 40% down. But remember, that's only our alternative scenario. And for this alternative scenario, we would before need to undershoot here this target zone at roughly the marker of 4,763 points. Up until this point, this scenario is completely uninteresting. As long as we stay above this marker here of 4,763, this scenario is of no interest. So no need to worry right now. You can start worrying as soon as we undershoot this target zone that we have printed here on the chart. And to finish it all up, taking you to the overreaching time frame. So this is the real long-term case that we have for the S&P 500 index. You can see here that our count here on this chart starts all the way back in 2000, and we have also here in 2000 established the wave 1 top. We have seen a long prolonged corrective move down to a wave 2 low all the way in August of 2009. Ever since, we have been in this 1, 2, 3, 4 waves upwards movement, and we are now currently working on this final overreaching wave 5 to complete this overreaching wave 3 that we just talked about on the chart before here, as you remember. And also here we have the same alternative scenario that I just showed you on the midterm outlook. But what's new here on this chart is that we also have our long-term price target for the S&P 500 index, and from current levels of roughly 5.5, this would be at least another 33%, and our optimum target would actually be a just roughly 50% higher than current price targets. So for now, that to me really looks like a good probability that we could already have seen the low in. But to really be sure and to not be caught off guard by new market action and price volatility, I would really highly encourage you checking out that link in the description, where you will get daily notifications and updates on every single market movement. And if you're just here to enjoy the free videos that we pump out multiple times a week, you're welcome. It's amazing that we have you here, but do not forget to turn on the bell notification, subscribe to this channel so that you will not miss any other video that we pump out. And up until then, take care. See you in the next one. Bye bye.